I'm Tyler Bollhorn, and this is the Tradescores Market Minutes for January 17th, 2011. This week I will look at the sector charts as I always do, with particular attention to the chart for gold, which may be breaking down. I'll discuss that for you. Plus we'll talk about how to trail a stop, how I do it. It's important to be able to trail a stop in the right way, or you can leave a lot of money on the table. Finally, I'll show you how to build a day trading watch list using the Market Scan tool on Tradescores. Well, let's get right into it. I'm on the Tradescores.com website. I have here a chart of the GLD ETF, which represents gold. And I want to highlight a few things on the daily chart, and then we'll jump over to the weekly chart. Of course, the weekly chart will give us a very different picture, but let's start off with the sort of short-term view here. We had a rising bottom, ascending triangle building there, but that upward sloping trend line was broken a few days ago, and that cycle of sort of level tops in the pattern has now been broken. We now have a falling top in the pattern, and that signals a good chance that we will see a pullback in gold in the near term. Now, the question is, how far does it pull back? Well, there's lots of support to hold gold up here. We've got a little bit of support right there. We've got support there. So the short-term downside is not considerable, but if we start testing those areas of support, we can start to build a longer-term breakdown in gold. Now let's jump over to the 5-year weekly chart, and this chart really demonstrates my primary concern, and that is that gold has gone up a little bit too quickly. If I draw an upward trend line for gold, we see it's something like that, and you can see that right now there's a fair bit of distance back to that long-term upward trend line. What happened is gold ran up very quickly in the later stages of 2010. It went sideways for a while. The buyers sort of ran out of their enthusiasm, and we're now starting that pullback process toward that long-term trend line. So the long-term picture for gold is reasonably good because that trend line remains up, but we could see a few weeks of pullback here coming back to that long-term upward trend line. In the daily chart, it really shows us how that breakdown is starting, and if you are long gold or gold stocks, I would be a little bit concerned in the short term. However, if you take a really long-term view, and again, that upward trend has been underway for a couple of years, I think that there is no reason to think that that upward trend can continue. Support at that long-term upward trend line should hold. All right, the next chart is the S&P 500, which represents U.S. equities, I think the best, being a basket of 500 stocks. Nice upward trend underway. We've been very stable in the more short-term sense. I do think that it's ripe for a little bit of a pullback like we had back there, and that could take it back to this long-term upward trend line, but there's really no sign of weakness yet, and I think you have to stay long U.S. equities right now. Canadian equities are in a similar situation. We have a nice long-term upward trend. We're a little bit above the upward trend line, which always means there is some potential for a pullback to the trend line, but this is a great upward sloping channel, and I think you should continue to be long Canadian equities as well, although we are seeing something of a sector rotation out of some of the mining names as there has been some weakness in commodity prices recently. Let's jump over to the currencies now. This is a chart of the US dollar index. It has pulled back in the last few days. We are now at support where it should bounce. The signal from the market today is that it will bounce. It managed to close above where it opened, and we're leaving us in this sort of sideways trading range after a break of the long-term downward trend. Now, if it bounces back but then ultimately breaks through that support level, we're going to make the next leg of the downward trend. If, on the other hand, it rises up to resistance and stalls there for a while and then breaks through to the upside, well, then we will have completed the process of a trend reversal. For now, the market really looks like it just wants to go sideways, and so I am neutral on the US dollar. The Canadian dollar is one of the stronger currencies worldwide. It is in a good upward trend. It has recently broken through resistance. I expect that the Canadian dollar will continue higher. It may pull back a little bit in the short term, but the long-term picture is that the Canadian dollar is moving higher from here. Of course, oil is an important commodity. It has a gauge of global economic strength. We can see here that the chart of oil is generally moving up. The tops are not rising as quickly as the bottoms. That sets up a rising wedge pattern, which can often lead to a breakdown. It's really a sign that the buyers are losing their enthusiasm over time, but it's only a bearish pattern if you get a break of that upward trend line. So for now, this is an optimistic pattern, although it doesn't have a lot of enthusiasm. The final chart this week is for the Emerging Markets ETF, symbol EEM. It was in a nice upward trend right in there. It has since gone into a consolidation phase where price is stabilizing over time with an upward bias. That is an optimistic pattern, but really neutral in the sense that we're going sideways. I expect that we will get a breakout given this optimistic consolidation higher, and I think that after this market takes a little bit of a breather, we'll see it break through to the upside. So to summarize then, I am positive on U.S. equities, Canadian equities, and oil, neutral on gold and the U.S. dollar, positive on the Canadian dollar, and neutral on the emerging markets. All right, let's talk a little bit about how to trail a stop. And what I mean by trailing a stop is that as your stock moves higher, you have an exit point that is a little bit below the high of the stock. And if the stock pulls back to your exit point, which is trailing behind the stock's price, you'll get an exit signal. It's a great way to lock in profits, but it's still allow for the upside. Now, one of the things that I don't encourage people to do is to set a price target. Why limit upside? We want to limit downside, not the upside, so always consider that when you are looking for the exit door. The best way to trail a stock, or pardon me, trail the stop on a stock, is to consider the volatility of the stock. I don't think it is a good idea to use an arbitrary number like a 10% trailing stop or a 20-cent trailing stop. You should instead consider the volatility of the stock and use that to trail your stop loss order. And this will make a little more sense when we look at an example. Let's do that now. Now I'd like to think of price volatility in terms of steps. You can see with this stock, if we were to have bought this breakout back here, we would have really made our first step up, where we consider that to be a step, and then the stock went sideways. Well, that first step defines our price volatility. Now what I do is when a stock closes above my next line, and these lines that you see here on the screen are drawn in multiples of the first step. So this particular step right here now defines each step higher as we go up. So if I get a close above a new risk-reward line, well, at that point, I then put my stop at the previous step. Here we've closed above this risk-reward line, so our step bottom is now here. We've now closed above this one, so our step bottom is here. If the stock were to pull back and close below the bottom of my step, well, then I've exited, and that's how that trailing stop works. Now, if you want to change your steps on these Tradescores charts, you can do that using the risk-reward line tool down here. You can see that if I enter in a different price right here, it will change the size of my steps. You should draw the lines at places where the market steps up from a period of sideways trading. So our entry signal, as I said, was here, which means that the bottom of our step is going to be right there, and that's why I entered $2.20 there, because it basically defines that step and is useful for defining my trailing stop through the rest of that trend. Alright, so the final thing that I want to do this week is talk about day trading. I like to day trade abnormal liquid stocks. They tend to move the best, they're easy to move in and out of. There is a market scan on the Tradescores website, or some filters on the Tradescores website that you can use to find these, provided you are an advanced or pro member of the site. Now let's jump over to Tradescores and I'll show you how that works. I am here in the market scan. We have a lot of preset scans, but of course you can build your own. What I like to do is just look at stocks that are having an abnormal volume day. I can select abnormal volume, trading, let's pick a number, 5,000 trades. That's pretty liquid. And then I could give that stock scan a name. I could call it Day Trade Demo. Click on Check to Save Scan, run the report, and it goes through all of the stocks in the market, and it found 95 that were trading abnormal volume and trading very liquid with at least 5,000 trades a day. These would be the stocks that I would consider for day trades today. Now, you can adjust these settings. If I was day trading the TSX, I might lower that number of trades to 1,000 and only look at the Canadian market. But what I do is I run this scan about an hour after the market opens, and then I use that list throughout the day to find the stocks that have the best potential to make big price moves. Well, that has been the Tradescores Market Minutes for January 17th. I hope you've enjoyed it. I hope you found it useful. For more information on the tools and services that we offer, give us a visit at www.tradescores.com or www.stockscores.com. Have a great week in the market and trade well.